I want to show you two charts. One of them I already have a position in. I bought it yesterday at $12.02. It's currently up about 2%. The other one I don't have a position in yet. Not because the setup isn't there, it absolutely is, but because the signal hasn't fired. And if you're the kind of trader who buys a setup before the signal fires, you will eventually give back every dollar you made catching early entries that worked on the single day one of them doesn't. By the end of this video, I'm going to show you exactly what my framework said about both of these instruments before I made the call. Not in hindsight, in real time. The scanner flag, the chart read, the entry, the stop, and what I'm watching next. The first chart is Ford Motor Company. The second is Netflix. And both of them tell a story that has nothing to do with whether you think Ford makes good cars or whatever you think Netflix has a great content slate. Because I don't trade fundamentals. I trade institutional volume structure. And right now, both of these charts have a very specific thing in common that the framework is designed to identify. So let's get into it. Before I go too deep in the charts, you need to understand two concepts. Everything I'm going to say about Ford and Netflix comes from these two things. If you watch my other videos, you know them. If you haven't, stay with me just for 2 minutes because without this foundation, the rest of the video won't make sense. So concept one is the anchored VWAP. The anchored VWAP, also called AVWAP, is the volume-weighted average price anchored from a specific structural point in time. In my framework, I anchor it from a start of a major swing, a swing high or a swing low. And what it gives you is the institutional cost basis for everything that's happened since. So here's why that matters. Institutions, they don't buy and sell the way retail traders do. They don't buy a breakout at the high of the day and panic sell 2 hours later. They build positions over days and weeks at specific price zones. And those zones are visible in the volume data if you know what to look for. The AVWAP is where the institution is sitting on average. When price is above it, they are in profit and their cost basis below supports the price. When price is below, they are underwater and they will use every bounce to distribute, not accumulate. The trade I'm going to walk you through, the Ford trade, was initiated at the break of the AVWAP. The break, confirmed with the right signal structure, is one of the cleanest institutional entries in the framework. Concept number two is volume compression. Every directional move in any market is preceded by compression. Think of it as a coiled spring. The market range contracts. Volume dries up. Volatility collapses. The spring is loading. When it releases, and it always releases, the move is fast and proportional to the compression that built before it. In the system I use, that compression is tracked as a percentage. 0 means fully expanded. The move is already underway. 100% means maximum compression, the spring is fully loaded, and release is imminent. Netflix today is at 81% compression. I'll go deeper in how it looks like in the charts in a few minutes. The number alone tells you this setup is close. The question is what it needs to fire, and I'll give you the exact answer. So those are the two concepts: AVWAP, institutional cost basis, volume comp, coil loading. Now, let's look at the chart. I want to start with something that I think is actually the most important part of the Ford story. And it is not the chart. It is how I found the chart in the first place. Now, 3 sessions ago, before anything visually notable had happened on the 4-hour chart, my daily scanner flagged Ford. And here is what the scanner said at that point. Bull deviation, HMM bull 98%. Conviction score 62 out of 100. That's the scanner telling me institutional divergence is building. The volume structure is becoming bullish while the price is still making lows or sitting depressed. The hidden Markov model, which reads the probable underlying institutional state, is registering a 98% probability of a bullish institutional regime. Is not confirmed yet, but it's building. Now the 62 out of 100 conviction means I don't take the daily time frame signal blindly. That's a mid-tier conviction reading. What I do with that is I drop down to the 4-hour chart and I ask, does the lower time frame confirm what the daily scanner flagged? So this is Ford on the 4-hour chart. Let me walk you through what I see. The stock peaked around 14.80 in late February. Then it sold off hard. By early April, right around the Liberation Day tariff announcement, Ford was hitting lows just around 11. A 25% haircut in 6 weeks. The narrative was straightforward. Ford is exposed to tariffs. It sources parts cross-border. Its margin gets compressed. The stock goes down. And the market priced all of that in very aggressively. But here's what the chart was doing while that narrative played out. Look at the buy signal. It started producing buy signals on the way down. And on this chart, they appeared as S23, S23, and S26 marker. A structured buy signal where 6 factors aligned simultaneously at the low. The confidence score at the time of those signals were 8 out of 2. That means 8 institutional factors are aligned, confirmed across 2 separate time frames simultaneously. That is not noise. That is the framework's way of showing you that while retail was selling Ford on tariff fears, something institutional was absorbing the supply at the lows. And then look at the volume compression. At the time the scanner flagged it at coiled 73%. The spring is loaded. The energy that built up during these 6 weeks of sell-off is sitting compressed in the volume structure, waiting for a release. So what I have is scanner flags bullish divergence. The 4-hour confirms with a confluence 8-2F. Volume compression is coiled at 73%, and AVWAP is sitting just below the current price, the level that, if broken, flips the stock from distribution to VWAP accumulation. That is the setup. Now here is the entry. So on April 8th, the price pierced through the AVWAP on the 4-hour chart and produced a S2 signal with a confluence score of 8-2F. That is the signal to start buying. So what I did was, instead of just buying at the close of the 4-hour candle, I waited until the 9th of April to see if we could have a retracement so I could get an even better price, which was 12.02 in my case. And this trade is purely technical, not because I have a view on Ford's product cycle or their EV strategy or what tariffs mean for their margins over the next 3 years. Because the chart said institutional cost basis is right here. The volume structure is bullish. The spring is now loaded at 73%. And the framework has a 100% win rate on this exact signal configuration across the last 11 completed cycles on this instrument. 100% win rate on 9 of 11 completed signals. So let me be very clear about what it means and what it doesn't mean. It does not mean the 12th signal can be a loser. Every trade has a stop for a reason. It means that historically, on this specific instrument, at this specific signal configuration, in a confirmed bullish institutional regime, the outcome has been consistently constructive. That's the statistical edge the framework is designed to identify. Let me show you exactly how I'm managing this position now that I'm in it, because this is where most traders, even traders who have the right entry, give back the money. They don't have a plan for what comes next. Here are my levels. I have a stop at 11.5. It's below the puck. It's below the structure. If Ford closes a 4-hour below this 11.5, the setup has failed. The institutional buying that appeared to be absorbing supply at the lows has not held. I'm out, clean, no argument. The distance from my entry is 12.02 to my stop at 11.5 is only 0.52. This is my defined risk per share on this trade. I know that before the market opens. I knew it before I even placed the order. Then I have an add level at 12.8, but, and this is important, only if the volume compression signal fires. The coil 73 compression is still building. When it releases, when the volume comp fires a signal at 12.8 or above, that is when I add to the position. The signal fire is the confirmation that the spring has released in the direction that framework predicted. Without the signal fire, I don't add, just because price go there. The compression release is the confirmation, not the price level alone. And here's the stop management rule that goes with the add level. If Ford reaches the 12.8, even without the vol comp signal, I move my stop to break even at 12.02. The position is no longer at risk. I'm playing with the house money. The worst outcome from that point is a flat trade. Then we have target 1. It is 360 to 14, this area. This is the prior consolidation zone before the February ramp began. Structurally significant, and it's where the stock built a base before the big move up to 14.8. Expect resistance here. It's where the stock built its base before the move up to 14.8. So expect resistance here at this area. The target 2 is the 1480. The February swing high. If the volume comp fires and the inflationary pump regime holds, which the framework currently reads at composite plus 6 out of 9, the strongest reading since before Liberation Day, 14.8 is in play. The reward to risk from 12.02 entry and 11.5 stop, 13.6 first target, approximately 3 to 1. The framework requires a minimum 2 to 1 setup quality to justify an entry, and this clears the bar comfortably. One more thing I want to say about this trade. The macro regime is not a headwind for Ford right now. The cancel and flow reading across every instrument in the terminal today is inflationary pump. What that means in this context is the tariff-driven inflation that was the bearish thesis for Ford, higher cost, compressed margins, is now being priced as a positive for the regime. Inflation pushes revenue higher in nominal terms. Liquidity stays accommodative to prevent a credit event. The inflationary pump is not kind to every business model, but it's not the kind of environment where a domestically relevant manufacturer with a beat up chart typically keep falling. The macro is not the trade, but it's not fighting the trade either. And that matters. Now, I want to show you Netflix because this is different. And understanding why I don't have a position in Netflix yet, despite the fact that this is one of the most compelling setups I've seen in weeks, is maybe the most important lesson in this entire video. Here is the Netflix 4-hour chart. The stock bottom at around $75 in February during the broad equity sell-off. It has recovered to approximately 102, a 30% move off the lows, a strong recovery, better than most. And the chart is telling you exactly why. Look at the strong deviation signals are printed at the 94 to 96 zone during the Liberation Day sell-off in early April. Multiple prints. This is the framework detecting institutional buying while price was making a fresh leg lower. The institutional footprint said accumulation at these levels. And price confirmed about recovering from 94 back to 102 in the subsequent session. So the accumulation signal fired. Price responded. And we are now at 102. That sounds like a setup that's done. The move already happened. But if you look at the volume compression right now, it is 81% coiled. So let me explain what it means for an instrument to recover 30% from its lows and still be at 81% compression. It means the move from 75 to 102 was not the compression release. The volatility during the recovery was absorbed. The range did not expand the way it would if the spring had released. The market pulled Netflix back up, but it pulled it up quietly, without the explosive expansion that characterized a true compression release. What 81% coil at 102 is telling you, the real move hasn't happened yet. The recovery from 78 was the base formation. The compression that has built on top of that base while price sat between 94 and 102, that compression is still loaded. When it fires, the move will not be from 78 to 102. It will be from 102 to what comes next. Now here's the confluence score. It is 6-2F. 2 frames of institutional confirmation building simultaneously within the compression. 2 separate time frames, likely the 4-hour and the daily, are both showing the same directional signal building. That is not one time frame getting excited, that is cross time frame institutional alignment. The confluence 6 on 2 frames with volume comp at 81% coil is what I call a pre-fire configuration. The framework has identified the setup, the engine is running, and it's waiting for the trigger to fire. And what probably will be the trigger is the earnings that are out on Thursday, the 16th of April. And now I want to address the question I know some of you are asking: why Netflix? What is the fundamental thesis? And again, there isn't one. And that is entirely intentional. Netflix has no direct tariff exposure. It is a subscription-based, digitally delivered product. It does not manufacture anything. It does not import components. In an inflationary pump regime, which is what the macro environment reads right now, Netflix is insulated from the primary headwind affecting Ford, Boeing, Caterpillar, and most of the names that have underperformed through the Liberation Day cycle. The insulation, combined with 81% coil compression structure on 2-frame institutional confirmation, is why the setup is at the top of my watch list heading into next week. The macro regime supports it. The chart structure supports it. The signal is loading, and I am waiting for it to fire. So let me put these 2 charts next to each other for a moment. Ford, the scanner flagged bull deviation 3 sessions ago. 4-hour confirmed on confluence 8 on 2 frames. AVWAP was triggered and entry was 12:02. Position is active now. The stop is below the POC 1150, and I will add at the 12.8 on volume compression signal fire. Netflix is volume compression at 81% coiled. The confluence score is 6 on 2 time frames. I don't have an entry yet. I'm watching the volume compression signal, and when it fires, that is the trigger. We have 2 different stages of the same workflow. Ford is the executed trade, Netflix is the setup waiting to fire. And both of them came from the same process. The daily scanner identifies the divergence. The 4-hour chart confirms the signal structure. The AVWAP defines the institutional cost basis and the entry level. The volume compression tells you how much energy is loaded. The confluence score tells you how many institutional factors are aligning across how many timeframes. That process does not require a view on tariffs. It does not require a prediction about Federal Reserve policy. It does not require a view on whether streaming subscribers growth slows in Q3 or whether Ford's EV ramp is on track. It requires reading the chart the way institutions are reading the charts. Because the institutions are always there. Their footprints is always visible. You just need a framework that lets you see it. If you want to follow both of these trades in real time, the Ford position management and the Netflix setup trigger, that is exactly what the daily brief covers. Every morning before the market opens, I publish the full framework read, regime status, which instruments are in pre-fire configuration, which signals have fired, and exactly how I'm managing open positions. The Friday brief is free. It goes out on Substack and it covers the week's key setups in the kind of depth you just watched. If you want the full session, the daily read, the live terminal with all 50 plus instrument updated before open, the scanner output, and the option signal generator for setups like this Netflix compression, that is the paid tier. The link is below. The first brief is free. Judge for yourself whether the framework makes sense. If this video helped you understand how I think about the charts differently from the standard price action approach, hit the subscribe button. I publish this every week. So I see you in the next one. Have a great Friday. Trade safe. Bye bye.